There is a recurring biological pattern in the evolution of technology. Whenever a revolutionary, decentralized communication network emerges, a parasitic institutional force eventually attaches itself to the system, working to infect and capture the host. In 1851, the telegraph began as an open frontier with over 500 competing companies. Within 15 years, a single monopoly, Western Union, absorbed them all, enclosing the infrastructure and dictating who could transmit information. The tactic relies on a specific mechanism, forcing all organic data through centralized gatekeepers. By mandating these proprietary on-ramps, institutions can monitor traffic, control access, and continuously extract rent. The history of communication networks is defined by this trajectory. Radical open innovation emerges, only to be systematically enclosed and captured by parasitic institutional forces. For over a century, this pattern held true without exception. Then came a network engineered to resist protocol-level capture, Bitcoin. Bitcoin relies on a process called proof of work, which anchors the ledger to the physical world through energy expenditure. Because the history of the chain is written in electricity already consumed, it cannot be rewritten by a court order or a legal seizure. To alter the past, an attacker must outspend the laws of physics. As this diagram illustrates, the institutional virus is forced to adapt. Unable to alter the core mathematics, it abandons the center and instead targets the surrounding infrastructure, attaching itself to the outer rings of nodes, miners, and exchanges. Because the protocol itself remains untouchable, the opposition must enclose the physical and financial entry points surrounding Bitcoin to domesticate the network. The initial strategy focused on direct destruction. Between 2013 and 2017, governments shut down early darknet markets like Silk Road and massive exchanges like Mt. Gox collapsed, resulting in a 6% loss of the total supply, yet the network continued producing blocks. The attackers discovered that without centralized servers to confiscate or a CEO to arrest, the protocol had no single point of failure to exploit. Realizing they could not kill the network, the strategy shifted to isolation. Regulatory agencies coordinated a widespread effort to sever the industry's access to the traditional banking system. In early 2023, the few banks willing to service digital assets were forced into liquidation or closure. Simultaneously, dozens of technology founders found their personal and corporate accounts abruptly closed without explanation. These isolation tactics failed to stop the network's momentum. Even as banking access vanished, Bitcoin's price recovered from $16,000 to $31,000 in just 8 months, as users increasingly turned to peer-to-peer markets and the Lightning Network to bypass the blocked gateways. The fourth phase abandoned destruction in favor of symbiosis. The new objective was to co-opt the network through custody, embracing Bitcoin to transform it into a heavily regulated institutional financial product. In early 2024, the approval of spot ETFs opened a new channel for capital. Tens of billions of dollars poured in as major asset managers offered investors frictionless exposure to the asset. Behind this massive influx lay a structural trap. Accounting guidelines effectively blocked traditional banks from competing in the custody market, forcing almost all of this new wealth into the hands of a small group of crypto-native entities. This created a new concentration of risk. By late 2025, ETF custodians held nearly 7% of the entire circulating supply, creating a centralized pool of assets that can be easily frozen or seized by the state. A significant portion of the network had been successfully domesticated. Users were trading away the security of private keys for the convenience of permissioned custodial accounts. The fifth and current phase focuses on financial enclosure. By leveraging partnerships with Wall Street custodians, the economic value generated by Bitcoin is quietly recycled into purchasing U.S. Treasury debt, supporting the fiat system it was intended to circumvent. While the financial capture accelerates, an internal technical mutation threatens the network from within. Institutional influence is weaponizing the blockchain's own structure through OP-return data bloat and speculative token standards. As seen in this diagram, recent expansions allowing up to 100 kilobytes of arbitrary data per transaction pump junk data into the ledger. This expands the storage requirements for a single block by over 1,000 times. This creates a direct physical barrier to participation. As the hardware cost to store and sync the blockchain rises, the ability for an everyday user to run an independent node becomes economically impossible. If the ledger grows so rapidly that only massive corporate server farms can afford to validate it, the network's decentralized nature vanishes. The protocol remains intact, but institutions regain the power to dictate which transactions are allowed. With corporate nodes dominating the validation process, Bitcoin begins to function as a centralized settlement layer, where users must once again trust third parties to verify the state of their wealth. To prevent this shift toward centralization, a technical proposal emerged from the user base, the BIP 110 User-Activated Temporary Soft Fork. This proposal functions as a firewall. By filtering out unnecessary data bloat from OP return and runes, individual nodes stop the parasitic infection. The software ensures the network remains within its original resource constraints, keeping the hardware to run a full node affordable. This proves that the defense of the network does not depend on mining pools or corporate executives. The security model relies on the users themselves choosing to actively reject data that threatens their ability to validate the chain. Once the filter is engaged, the path toward corporate capture is severed. Across the globe, thousands of small, independent nodes light back up, restoring the distributed balance of power. Financial sovereignty cannot be purchased through a managed fund or a custodial account. It is a state that must be actively maintained by holding your own private keys and running your own independent node. To survive the evolving mutations of institutional capture, users must activate their immune response and choose to maintain their own path to the network.